Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 10K, basically a yearly business and financial checkup for Elite Performance Holding Corp. I know the name sounds like a gym chain, but trust me, the story is much more unbalanced than a weightlifting session gone wrong. This report gives us the inside scoop on how they performed last year, what they're worried about, and where they plan to go. Let's jump in. The report is for the year ended December 31, 2024. It's important to keep that date in mind as we look at the numbers. This is a look back, not a crystal ball. Elite Performance Holding Corp, the company we are investigating, calls itself a holding company. That means they own other companies. Their focus is on the health and fitness industries, including sports drinks and nutritional supplements. As of June 30, 2024, the company says that the total market value of the company's stock held by regular investors was only around $9.6 million. This is a pretty small number which can make the stock price jump around more easily. Now let's go straight to what's for dinner today, the financial results. First, the balance sheet. Think of this as a snapshot of what the company owns and owes. Accounts payable are the bills that the company has not yet paid and are $835,695. But here's the big one, the accumulated deficit. This is all the losses they've added up over time, and it's a whopping $11.1 million. That's a huge hole to dig out of. Now let's check the income statement. This shows how much money the company made and lost over the year. Elite Performance Holding Corp did $681 in revenue. That's not a typo. $681 in revenue. You could probably make more money busking on a street corner. The cost of goods sold, the direct expenses of creating products was a massive $36,321. It cost them way more to make something than they receive in sales. That is obviously not a great business model. This all comes down to an operating loss of $2.1 million. Ouch. Net loss, all things considered, was about $233 million. It appears that the company is not doing well. Now, let's talk about whether the company can even stay in business. The report states that there is a real risk about the company's ability to continue and says that this depends on generating profits and obtaining financing. Basically, can they start making money or can they borrow more to stay afloat? Now let's go through all of those risks or potential threats to the company's future. The first big risk they mention is that they have limited cash. They've been losing money and they need more money to keep their plans going. If they can't get more cash, things could get really tough. Next, they talk about the general economy and say that a slowdown could hurt them. People might stop buying their products if they have less money to spend. The company also points out that losing key people, especially the CEO, could be a major problem. If the person in charge leaves, it would be hard to find someone to replace them and things could slow down. Also, the business depends on keeping up with customer trends. If they mess up, they could lose sales. The company says that if they can't keep their brand strong, it could hurt their sales. If people don't recognize or trust the brand, they won't buy the products. Growing too fast is also a risk. If the company expands too quickly, it might not be able to handle it, and that could cause problems. The report admits that their stock isn't even trading on a major market. This makes it harder for people to buy and sell the stock. Related to that, their stock might be considered a penny stock, which brings extra rules and makes it harder to sell. One person, Joey Firestone, controls the vote on basically everything. He can decide who's on the board and what big decisions the company makes. The company admits that they may not have great accounting controls. If they can't keep track of their money properly, it could cause big problems with their reports and even lead to fraud. If we fast forward to item 5, this part talks about what the company calls a penny stock. Currently, the company's common stock is not quoted. This means there is not a formal price set for the stock, and trading may be difficult or impossible. Here it stated that shares were issued to consultants at a price of $1 per share. This shows what the company thinks their shares are worth, at least when they're paying someone with them. Moving on, the report discusses how the board of directors handles risks. The CEO is in charge of figuring out and dealing with cybersecurity risks. Also, as of right now, the company isn't aware of any cyber attacks that have seriously hurt the business. Let's discuss related party transactions. This is where it gets interesting. The company owes a lot of money to people closely connected to the business. The report claims that as of the end of the year, inventory was zero, while as of December 31, 2023, it was about $30,000. This seems like a very strange claim. In short, the company needs cash. After the year was over in 2025, the company issued more shares and secured more convertible notes. This reinforces the company's need for money. Now let's step back and take a look at the big picture. Elite Performance Holding Corp is in a tough spot. The financials speak for themselves. Almost no revenue, big losses, and a reliance on debt. All of the risks they list aren't exactly reassuring either. Also, the report claims that as of the end of the year, the company had zero inventory, which is hard to believe. However, they do have some potential upside. They're trying to break into a growing market and they claim to have a unique product. If they can turn things around, there's a chance they could find success. Overall, this company is a very risky investment right now. They need to show that they can actually sell their products and manage their money better. Thanks for watching. Hit like, subscribe, and comment what you think they should do.